Investment decision-making process. Overview and strategic importance. The investment decision-making process is the structured evaluation of alternative capital projects to determine how resources should be allocated to maximize shareholder wealth. It connects strategic objectives with operational execution, ensuring that capital expenditure, CapEx, aligns with long-term organizational goals. Investment decisions typically involve substantial financial commitments and irreversible outcomes. Therefore, they require rigorous analysis, stakeholder consultation, and risk assessment. The process begins with identifying strategic needs, such as capacity expansion, product diversification, or technology renewal, and continues through financial appraisal, approval, and post-implementation review. Sound decision-making integrates both quantitative tools, NPV, IRR, PI, and qualitative assessments such as strategic fit, environmental impact, and managerial capability. This disciplined approach enables management to prioritize projects with the highest risk-adjusted return and to ensure that each investment supports sustainable competitive advantage. Origination of proposals. Investment proposals originate from multiple levels within an organization. Operational managers identify opportunities to improve efficiency or expand market share, while strategic planners initiate proposals tied to corporate growth. Proposals are formalized through business cases detailing objectives, expected benefits, cost estimates, and risk analysis. Preliminary screening ensures alignment with strategic plans before detailed evaluation begins. The origination phase benefits from cross-functional input, finance, engineering, marketing, and operations to ensure completeness and feasibility. Early identification of value-creating ideas supports innovation and adaptability. However, without clear evaluation criteria, organizations risk bias or political influence in project selection. Thus, transparent proposal processes supported by documented assumptions and governance controls form the foundation of sound capital budgeting practice. Creation of capital budgets. Once proposals are approved for detailed evaluation, they enter the capital budgeting process, which quantifies financial viability and resource requirements. Budgets summarize all anticipated cash inflows and outflows, incorporating investment costs, operating revenues, maintenance expenses, and residual values. Financial appraisal techniques such as net present value, NPV, internal rate of return, IR, payback, and accounting rate of return, AR, are applied to estimate profitability and risk. The capital budget also integrates funding strategies, highlighting whether projects will be financed through retained earnings, debt, or equity. Prioritization occurs when capital rationing limits available funds, using criteria like profitability index or strategic importance. This phase ensures that investments compete on transparent, objective grounds, optimizing portfolio balance and liquidity while maintaining organizational agility. Evaluation and risk assessment. Comprehensive evaluation combines quantitative and qualitative considerations. Financial metrics assess expected return and cash flow stability, while sensitivity, scenario, and Monte Carlo analyses model uncertainty and assumptions such as sales volume or input costs. Non-financial factors, such as environmental compliance, employee welfare, and brand reputation, are also evaluated to ensure alignment with corporate values. Risk assessment may incorporate adjusted discount rates or certainty equivalents to reflect project-specific risk levels. The use of real options thinking allows flexibility to revise or defer decisions under uncertainty. This integrated approach ensures that investment appraisal reflects the multidimensional nature of business decisions, balancing financial performance with strategic resilience. Go, no-go decision and approval. The culmination of the investment process is the go, no-go decision made by senior management or the investment committee. Decisions are based on appraisal outcomes, strategic alignment, and resource constraints. Projects meeting or exceeding hurdle rates and qualitative standards proceed to implementation, while marginal proposals may be revised or postponed. Capital rationing often requires ranking projects using metrics such as profitability index, PI, which measures value created per dollar invested. Governance mechanisms, including board oversight, audit review, and documented approvals, ensure accountability and transparency. A robust approval framework mitigates the risk of overinvestment or political influence, reinforcing shareholder confidence and disciplined resource allocation. Post-implementation review and feedback. After approval and execution, projects undergo post-implementation review to evaluate performance against planned objectives. Variance analysis between forecast and actual cash flows identifies areas for improvement in forecasting accuracy, cost control, and operational performance. Lessons learned feedback into future decision cycles, strengthening organizational learning and investment governance. Continuous monitoring ensures that underperforming projects are corrected, divested, or restructured promptly. This feedback mechanism closes the investment loop, embedding continuous improvement into capital management. By institutionalizing review processes, organizations sustain accountability, improve future project selection, and enhance overall capital efficiency.